Bitcoin is the best in class for digital assets. It's got by far the biggest network effect, the most security, the most simple and robust design, the best kind of structure to maintain its long-term decentralization. To answer your question, I don't view it too much as competition for gold for a couple of reasons. One is I think that there's room for both of them.
Yeah.
Two, so far there's been different buyers. So central banks have been really, sizable buyers of gold as of late. Bitcoin is more like corporate buyers this cycle, to some extent, retail buyers. And the East is more active in gold markets, and the West is more active in Bitcoin markets, at least in this current cycle. So I don't view them as too much in competition. In addition,
Lyn Alden starts off by looking at a significant change in the global financial system structure that not many policymakers publicly recognize. Banks created money through lending, and the Federal Reserve changed interest rates to affect that behavior. In the past, private sector credit cycles dominated the U.S. economy. However, a subtle change has occurred within the past 20 years. The focus has shifted from monetary policy to fiscal policy. Alden emphasizes how the conventional wisdom of inflation control is called into question by this shift. The Fed may raise interest rates, but money will continue to enter the system despite higher borrowing costs if the federal government continues to run significant deficits, spending more than it takes in from taxes. Rate increases now contribute to increased government interest costs, which in turn need additional borrowing, creating a vicious cycle that may potentially increase inflation rather than reduce it. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
Does this mean that the Fed has lost control of inflation expectations, or is it monetary policy now being boxed in by these structural fiscal obligations?
So I think lost control is perhaps too strong of a word, but I think that the Fed's tools are much diminished compared to what they were before. And the reason for that, this is sometimes hard to phrase concisely, but basically back, for example, in the 70s, you had low public debt to GDP, and most of the money creation was from bank lending, because the baby boomers were entering their home buying years, which was peak credit formation in a lifetime. So you had above target, above trend bank loan creation, and federal debt to GDP is pretty low. So if you want to slow that down, which is what Volcker wanted to do, he jacked up interest rates super high. And what that did was that generally slowed down bank lending. It made borrowing less attractive, slowed down the rate of money creation through the lending channel. Now, it did blow out fiscal deficits because suddenly, the federal interest expense was much higher. But because that was a low stock of existing debt to GDP, the general trend was that you slow down bank lending more than you blew out the deficit. So you did have a net slowing effect on total credit creation. You also, and this is the part that's less talked about, you strengthen the dollar rapidly, and you basically impair various emerging markets that were dollar denominated, and therefore make them less able to consume things like oil, and basically, impair the supply demand balance for some key commodities, which left more for the U.S. But that's the third thing that's not really often discussed. But going back to that kind of credit creation channel, the problem now is that if you have very high public debt to GDP, like let's say over 100% relative to the 35% that it was back in Volcker's time, when you raise interest rates to try to slow down bank lending, there's two issues. One, bank lending is not above trend right now. Excessive bank lending was not to blame for the inflation we saw in recent years. And two, when you do raise interest rates, you increase the federal deficit now at a faster total amount than you slow down bank lending. So basically what that means is that the Fed's tools for slowing down total credit creation don't really work anymore. Now it doesn't mean that they don't have any levers. It just means that those levers kind of work differently. They have more of a lag. They're not as powerful anymore. And I think that's the new environment that we're in. This could be considered a trial balloon. Basically, they put out a lot of headlines from directly from the White House and officials saying that they were maybe going to do this. Poly market odds spiked to something like 35%. At the same time, there was a pretty rapid, not a very large one, but a pretty rapid drop in the dollar index. And there was a drop in stocks and the long end of the treasury curve, meaning that yields went up. That's generally not a successful trial balloon. So if they had announced this news and the dollar was firm and yields went down, which is kind of what they want, then it's possible they would have gone through with the attempt. But because the trial balloon was basically saying that you kind of get the emerging market effect on your assets if you do this, it could have affected their decision. Hard to say either way what the counterfactual would have been. There's also legal questions. I mean, do they want that legal fight? Because the chairman can be removed with cause. And whenever you have a legal term like with cause, that's going to be debated if there was cause. So that could be a protracted fight that could be distracting from other things. So my base case is they won't remove him, but as headlines have kind of shown, it's certainly a possibility. The market's already shown what it thinks of it whenever these headlines flare up.
Lyn Alden's discussion of Bitcoin and gold as complementing assets rather than competitors is among the most intriguing aspects of her talk. Alden thinks both are crucial components of a contemporary investment portfolio, despite the fact that some experts attempt to set them against one another. The larger and more reliable asset is still gold. It is supported by central banks worldwide, has a market capitalization around 10 times that of Bitcoin, and is less volatile. According to her, gold continues to be the most important source of monetary value. On the other side, Bitcoin is more recent, more erratic, and has more room to expand. It is distinct from other digital currencies due to its transparent blockchain, fixed supply, and ease of mobility. Alden asserts that gold isn't necessarily losing value due to Bitcoin. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
So I still generally don't view long-end treasuries as particularly compelling. I don't think they'll do as poorly as they did over the past 5 years. So I've been a noted bond bear, starting from the time when yields were very low, and there were 18 trillion negative yielding bonds out there at the time. That major washout is probably behind us now. But generally speaking, with long duration bonds, treasuries, you're going to get volatility without a lot of return potential. So while they might be useful for a trade now and then, they don't trade the way they did during monetary dominance. And in general, they're just not that attractive compared to scarce assets. If someone wants a lower volatility asset, I do think that T-bills or other types of cash equivalents are interesting, especially if you expect, kind of intermediate term periods of volatility. So for example, we talked before, this very large in wave of tariffs. Generally speaking, you probably need to see some sort of market event to have some of them be pared back. So if someone wanted to make that trade for 6 months, then raising cash is probably not a bad idea. But in general, over the multi-year long term, my opinion is you want to be in relatively scarce assets. That's high quality equities, that's gold, that's Bitcoin, certain real estate that's not overpriced, and generally you also want to find entities that can short the currency. I mean, part of what makes corporate equities attractive is they've issued like 20-year bonds at 2 or 3%. So they're basically right along with you, shorting the currency and then owning better assets. Same thing for some of these Bitcoin companies like MicroStrategy that have taken out like zero coupon convertibles, buy Bitcoin with it, and have like 5-year durations on it that give them a lot of runway. So those types of strategies I think continue to make sense in this environment. I generally like the short end of the curve more than the longer end, just in terms of risk reward. I generally use hedge more sparingly because hedge protects you in a very specific environment. So if you're worried about stocks going down, you buy puts, which is a hedge. Bitcoin and even gold are not necessarily CPI hedges, because if you get a spike in CPI, you're more likely to get a hawkish central bank, which is generally not always great for scarce assets, at least temporarily. What I generally view it as, it's protection against long-term monetary debasement. So as currencies, the supply of currencies keep going up, you generally want to own scarcer things. And then for the scarcer things you own, you want to own best in class. So you want to own the best equities rather than the worst equities. You want to own the best commodities rather than the worst commodities. For the best commodities, generally speaking, that's gold. That's the lowest stock to flow ratio. That's the one with the most monetary premium. Bitcoin is the best in class for digital assets. It's got by far the biggest network effect, the most security, the most simple and robust design, the best kind of structure to maintain its long-term decentralization. To answer your question, I don't view it too much as competition for gold for a couple reasons. One is I think that there's room for both of them. Two, so far there's been different buyers. So central banks have been really, sizable buyers of gold as of late. Bitcoin is more like corporate buyers this cycle, to some extent, retail buyers. And the East is more active in gold markets, and the West is more active in Bitcoin markets, at least in this current cycle. So I don't view them as too much in competition. In addition, gold is much lower volatility. It's about 10 times larger of a market based on most estimates if you look at like the World Gold Council. Now we can audit the full supply of Bitcoin and know it down to the decimal point. We can't audit the full supply of gold, so we have to rely on estimates. But generally speaking, gold's about 10 times bigger, obviously has a much longer track record. Where I would say that Bitcoin somewhat competes with is other precious metals exposures, generally the higher volatility ones. So historically, if someone was bullish on precious metals, gold would be like the lower volatility one you might never sell. Whereas like silver, platinum, gold miners, these types of ones were generally considered more volatile plays on that trend. And I'd say to some extent they do compete with Bitcoin and maybe to some extent broader crypto, which is you have these more volatile non-fiat currency assets that now kind of fractures the liquidity to some extent, where buyers have more choices than they used to. So I do think that Bitcoin to some extent competes with that, but less so with gold. At least anywhere in this cycle. I mean, I think all these trends support both Bitcoin and gold. I've been long both for many years. The way I generally phrase it is if you start with a 60-40 portfolio, you might want to consider replacing some of your bonds with gold, and you might want to consider replacing some of your equities with Bitcoin, because you're talking about different levels of volatility of the assets. Right. And that's so far been a great trade. Bitcoin's outperformed most equities, and gold's generally been much better to hold than most bonds, especially sovereign bonds, over 5+ years and counting. Longer term, depending on what starting point you want to go with. But basically, I think this is an environment where you continue to want to own scarce assets, and notably want to hold scarce assets that are the best in class for whatever it is that they do, and that they're not getting diluted in market share by other things. So if you own equities, you want to own the best ones at reasonable prices. If you want to own, crypto, you want to own the best and biggest self-sustaining network effect, in my opinion.
According to Lyn Alden, hedging is most effective in certain situations. For instance, you could purchase a put option, a traditional hedge, if you're concerned about the stock market declining. However, neither Bitcoin nor gold are ideal short-term hedges against inflation, particularly when it comes to abrupt increases in the consumer price index. This is due to the fact that central banks frequently boost interest rates in response to a spike in the CPI, which can momentarily impair the performance of valuable assets like gold and Bitcoin. Alden thinks that Bitcoin and gold are superior long-term safeguards against currency devaluation since they tend to keep their value better when governments print more money. She adds that it's critical to concentrate on best-in-class assets, the most dependable and robust choices in each category when investing in scarce assets. That implies reputable firms for stocks, gold for commodities, and Bitcoin for digital assets. She points out that there isn't much of a competition between gold and Bitcoin. Bitcoin is more well-liked by corporate treasuries and individual investors in the West, but gold is preferred by central banks and other institutions in the East. The market for gold is 10 times larger than that of Bitcoin and is significantly less volatile. However, Bitcoin excels in network security, portability, and transparency. Curiously, according to Alden, Bitcoin is more of a rival to high volatility assets like silver, platinum, or gold mining stocks than it is to actual gold. Historically, investors seeking higher reward plays have been drawn to these assets. Currently, a portion of the money is going into Bitcoin. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.